Hey guys, I hope all of you are well. And today we'll be looking at a Leases question. So with this question, basically we're gonna do the lessor and the lessee's part. So I also want us to look at the different type of leases. So we have two options when we're recognizing a lease. It's either we could have the lease. So we can either, the lessee can choose to recognize the lease, or they can choose the simplified approach method. So basically, if we choose to recognize the lease, we'll recognize the journals as normal. But if we choose the simplified approach, it means we'll not recognize the lease in our books. We'll just instead account for the lease transactions in our separate books. So the first one, I'm gonna do a normal lease whereby we'll recognize the lease info. And in the second example, I will show how the treatment should have been if we selected the simplified approach. So let's start the question. A lease Ltd leases a vehicle from B Ltd from 1 January 2017. A Ltd did not elect the simplified approach method to account for the underlying asset in its individual financial statements. The following information is available in connection with the lease. The fair value of the underlying asset amounts to 150,000. The lease term is 10 years. Equal lease payments amounting to 25,637 payable in arrears. A Ltd and B Ltd incurred initial direct costs amounting to 10,000 and 15,000 respectively. Guaranteed residual value is it's 20,000. Ownership of the vehicle does not transfer to A Ltd at the end of the lease term. A accounts for all items of property, plant and equipment on the cost model in terms of IAS 16, property, plant and equipment. A Ltd always discloses future lease payments in the lease liability note separately for the following financial years. So let's start. So with this information, we have to calculate the lease liability. So we're gonna start by calculating the implicit interest rate. So let's say implicit interest. Excuse the handwriting, guys, but I hope all of you can see what that means. So the lease term is 10 years. The PMT, the payments are gonna be 25,637 per month, and the present value is gonna be 150,000 plus the amount ALTD, since the amount that BLT incurs is there, the lessor, which is gonna be 15,000. So this is gonna be 165,123, and the future value is gonna be 20,000, since they said we guaranteed that would pay them 20,000 at the end of the lease term. Then we'll have to compute the I. Therefore, we'll get once we compute all of these, once we put all of these into our financial calculator, we should get 10.03. Then once we do this, this is the implicit interest rate. It's 10.03. Just make sure that's let me just make sure that this is clear. It's gonna be 10.03. So now, once we put this into the financial calculator, we should get this. Then, since with this one, remember this, guys, don't make this mistake. So when you calculate the implicit interest rate, if the guaranteed residual value is not different, or the information from the information that you used when you calculated the implicit interest rate is not different than when you calculate your lease liability. There's no need to calculate the lease liability again. Let's say, for example, if this was different, if there was an unguaranteed residual value, we would have to calculate the lease liability separately to only include the guaranteed amount. But with this question, there was only a guaranteed residual value. So if right now we were to calculate a lease liability, the amount would be the same. We'd actually get this amount. So right now, it would maybe differ slightly because of rounding and stuff like that. But right now, since there's no guarantee, there's no unguaranteed residual value, which means our inputs will not change. So there's no need to calculate the lease liability again because it's already given, because the lease liability is the present value of the asset that the lessor is giving us. So the lease liability is going to be the lease liability is going to equal to 165 because the lease liability is the present value of the asset that we're about to receive from the lessor. It's the present value of the asset that we're going to receive from the lessor. So right now we have to compute our right of use. We have to calculate the right of use. So the right of use is going to be the 165,123 plus any amount that ALTD incurred while getting into this lease. And that is going to be 10,000 here. So we're going to add 10, 1, 2, 3, which is going to give us 175, 1, 2, 3. So basically the right of use, it's basically like we're going to capitalize all the costs that we incurred to get we're going to capitalize all the costs that we incurred in terms of the lease that the lessor does not reimburse us for. Yeah, so that's the thing. So that's the right of use. That's why we added this, because this was initial direct costs incurred to enter into this lease. So now we're going to have to do the journals for this. So the journals are going to look like this. So the journals. So the journals are going to look like this. We're going to debit the right of use. We're going to debit the right of use and we're going to credit the lease liability. So this we're gonna debit it with 165. There are many ways in which you can generalize this, but I'm gonna do it like this so that you guys can understand it a bit better. So we're gonna say 165, 1, 2, 3, 165, 1, 2, 3. And then here I'm gonna say, we're gonna debit the right of use with 10,000, which is the initial direct cost that should be capitalized. And here we're gonna credit bank with 10,000. This journal is to indicate that we incurred 10,000, which we paid for, but we're gonna have to capitalize it to the right of use, so that we're gonna have to capitalize it to the right of use, which when we add this together, it will equate to the 175. I hope everyone understands. I hope everyone understands how this was done. Then we're gonna here, then we're gonna have to recognize all the other journals. So here we're gonna have to calculate depreciation, because now the asset is in our books. And remember, when we calculate depreciation on a lease as a lessor, we use the lower of the expected useful life of the asset, or the the or you depreciate the asset over the lease term, the lower of the two. So here I'm just gonna say accumulated because it's gonna be a bit too long here. So it's gonna be, the calculation will be the 175,123 for the right of use divided by 10, because we didn't get the initial, they didn't give us what the initial depreciation of the vehicle was. We're only gonna use the lease term here. But if it was given, we'd have to use that instead. So this is gonna give us 17,500. 17,500. So that is the depreciation. Then now we'll have to calculate the financial bits of the lease, the finance costs and the payment. So now we're gonna say debit finance cost. You can also call this interest and just indicate that this is a P&L item. P&L item. So this is gonna be over amort 1 and 1. Then we're also gonna debit the lease liability, and we're gonna credit bank. So basically each year the receiver will have to make a payment of 25 637 as shown here. Every year we'll have to make this payment here, the 25 637, and here when we compute this into a calculator mode 1 and 1, it gives us 16 553, and the lease liability will be the principal amount, which is 908. So once all of these have to add up to this, so this is how we would account for the lease in terms of if this was a finance lease, and if we didn't elect the simplified approach. So let me just show here if we elected the simplified approach. If simplified approach is elected. So basically what's going to happen here, if we elect the simplified approach, it would mean that we'll not recognize the lease as we did above, would not recognize the lease in our books in full, because it would mean that probably maybe the lease term is less than 12 months, or it's just for 12 months. So here, what would basically do, but I'm just going to do this example so that you guys can get the context of it, like how to just account for it, the journals you should be recognizing. So this is how we do it. If it was either the journaling for if it was a low value, and if it was a simplified approach, it's the same. The journals are the same. So this is how we do it. So we take the payments, which is that 25,637, and then we'll multiply it by the lease term. This lease term is because of this lease, like it's not, I get it, like usually with the simplified approach you have to be less than 12 months or so, but here, so that like it, to just give you guys context, it would be like this. I would say 25 times 10, then the answer of that I would add the 15, the direct costs we incurred, then we'll divide this by 10. Then it gave us, it gave me 27,137. So this is the amount we got. This is how much basically we would expect to receive. This is basically how much the lease, based on all the payments computed together, divided by the term plus the direct cost would give us. So the journal would be this. It would be lease expense And then here, we would have to pay it. So it would be bank. But remember, we're going to pay what we agreed on. But that's the amount that the lessor, more or less, this is the amount that the lessor more or less would expect to get. But we actually going to pay him this 25 because this already incurred in a way. Because we already incurred this 15 when we entered into the lease. Already incurred it. So this is how much it would be. So here it would be 50, it would be 25, 6, 3, 7. Then here it would be 27, 137. And the difference between the two would be lease accruals because we're paying less than what the value of the lease is. Then the difference between the two would be the lease accruals, which would be 1.5, 1,500. We have to create this. So this is how it would be. So this is the value. Basically, this is what, when we calculated the whole thing, we said this is what we believe the lease will cost us. But remember, we incurred this at the beginning. So monthly would pay this, then the difference would be the lease accruals of 1.5. This is what would actually go into our financial statements, the lease accruals, because we wouldn't recognize this, we'd only recognize the lease accruals. And since we elected the simplified approach here with this second example, basically what's this, would not recognize the right of use or the lease liability in our books. Would only recognize the lease accruals. With this one also, there would be no need to compute depreciations and stuff like that, because depreciation wouldn't actually, the lessor will calculate depreciation on the asset because we wouldn't have full ownership of the asset. The lessor would. So it would still be basically in their hands. We'll just be gaining, like obtaining economic benefits of the asset, but without actually us owning it. So this is how this is done. So this would be if we elected the simplified approach. You just do this journal in your books for the year, and that would be you basically accounting for the lease. So that's the end of the video, guys. I hope all of you understand how I did all of this, and in the next video we'll be looking at how a lessor would have accounted for the lease in their books. Bye, guys.